Good afternoon, dear students. In the last video, we have started the fourth module of income tax, that is income from the other sources. The basic of charge, the following condition must be satisfied. These conditions should be fulfilled. Those are like there should be a capital assets. Assessee should transfer the capital assets. The transfer of capital assets should take place during the previous year. Then there should be a gain or a loss on account of such transfer of capital assets. Such gain should not be exempt under section 54, 54B, 54EC, 54F, G and GA. So these are the conditions which should be fulfilled to call any income as a capital gain. Right? Last video we studied the theoretical part of income from other sources. Today we will study about capital gains. When you sell any of your capital assets, right, capital assets or properties, and if you get any gain by selling your capital assets, that gain particularly will be called as capital gains. So the conditions are there should be a capital assets, assessee should transfer the capital assets, transfer of capital assets should take place during the previous year. If in the previous year if it is not done, if it is transferred prior to the previous year, means long back if it is been transferred, then that particular income will not be called as the capital gain of the current assessment year, right? Now what are capital assets? These are said in section 2 subsection 14 of Indian Income Tax Act. Capital assets means any property held by assessee will not include following. It is the property which is there with the owner, or ownership is there with the particularly a businessman, and the assessee will not have include these following things: stock in trade held for a business, agricultural land in India but in urban area, an area with a population more than 10,000, items for personal effect, personal use including jewelry, precious stones, archaeological collections, drawings, paintings, sculptures, and special bearer bond, which is said in section different sections of 1991. Instrument does not exist at present. Then if you see gold deposit bonds 1991, okay, these things if it is there, they are included, those are not called as capital assets. Apart from that, any other things which is having as the investment, which is calling as the capital investments, those all things are treated as capital assets as per section 2 subsection 14 of Indian Income Tax Act. Any other property you may take building, you may take land, you may take premises, you may take office premises, any other capital assets, any other capital investments, those are capital assets. But the things, the 6 points what we have seen are not the capital assets. Now, non-existence of the definition of the property. The property, we don't have an exact and a proper definition, but the word property is used in section 2 subsection 14 includes not only tangible assets but also intangible assets. Property can be both. It can be tangible assets, means which you can see and touch, those are tangible assets. And the property can also be in intangible assets, like it can be your goodwill, it can be your patents, or it can be anything which you can't see and touch, goodwill especially, right? The word property does not mean merely a physical property, but also includes rights, title or interest in it. It can be anything, but it doesn't mean only physical property, right? It can be the property which you can't see and touch also, right? So the property definition is also there. Then there are certain types of capital assets. Based on the time or a duration, the assets have been classified under income tax. There are two main classification of capital assets. First type of capital assets is short-term capital assets. An assets which is held by an assessee or the taxpayer for less than 36 months, right? If you held that assets from the date of buying till whatever period you hold it, and the time is less than 36 months, immediately before it transfer is called as short term capital assets. In other words, if you can say it, an assets which is transferred within 36 months of its acquisition by an SSE. You bought it today or you bought it before 36 months and you are selling within 36 months. So such particular assets which you sell before 36 months of completion of the days from the date of acquisition, those assets are short-term capital assets. Now come back to the second type of assets. Those are long-term capital assets. An asset which is held by an SSE for 36 months or more immediately, right? If it is held for more than 36 months before its transfer, it is called as long-term capital assets, right? If you are having ownership of a capital assets, if you hold for more than 36 months during the previous year, and if you sell it, whatever gain you get, that is called as those assets are called as long-term capital assets. Okay. The period of 36 months is taken as 12 months under the following cases. The 36 month is the period we take to divide whether if it is less than 36 months, we call it as short-term capital assets. If it is more than 36 months, we call it as long-term capital assets. But the period of 36 months will change to 12 months under the following exceptional cases. What are those cases? First is equity or preference shares. In case of the investment in shares, especially in equity shares or preference shares, if anybody is doing any investments and such kind of sale of the shares and such kind of investments will be converted as 12 months, which means if you hold the assets for less than 12 months, those are short-term capital assets. If you hold those equity shares and preference shares for more than 12 months, suppose you hold, you are having the ownership for 14 months, 15 months, in that case, the gain on the equity and preference shares will be called as long-term capital assets itself. Similarly, securities like debentures, government securities, which are listed in recognized stock exchange, units of UTI, units of mutual funds, zero coupon bonds. So any kind of investments you take, whether it is debenture, whether it is government securities or UTI or mutual funds, all investments, those all things will be taken into consideration of 12 months, right? 12 months is the base period for it. Now, types of capital gains. The profit on transfer of short-term capital assets, STCA, which means the profit on transfer of short-term capital asset is treated as short-term capital gains, which is said in section 2 subsection 42B of Indian Income Tax Act. Similarly, while the profit on transfer of long-term capital asset is known as long-term capital gain.